Time now to talk about what's happening with the CV market in India, which is a core indicator of pickup in economic activity and the investment demand trend reviving. And that's the reason why we're touching base with the management of Chola Investments to understand better the pickup in the CV, LCV sales and production, and to understand how they would be able to maintain that 2025, actually 25 to 30% compounded annual growth rate over the course of the next 2 to 3 years. N. Srinivasan, who's Executive Vice Chairman and Managing Director of Cholamandalam Investment and Finance, joins in with his perspective. Mr. Srinivasan, it's great to have you on the show. If you look at the industry trends, we are seeing a sign of pickup in CV sales and production, and not just, the medium and heavy commercial vehicles, but also light commercial vehicles. What is your view on this recovery, and thereby, as a derivative of that, what that would mean for extending our finance to these businesses?
You see, I think, the Q2 had shown a very large growth of about 31%. The industry actually really bounced back. Of course, there has been some pent-up demand, which was satisfied in Q2. And October actually been a festive month, and sales have also been good. But right from the year beginning, the financial year, actually the LCVs and tractors have been growing in double digits. So on the whole, I think, the worst seems to be over, and then, the LCVs, the CVs generally are on a comeback trial. ICRA has just recently released a very detailed report, segment by segment, and their assessment is about the industry will probably grow about 6 to 8% this year, and probably by at least a double digit in the next financial year. There are a number of triggers, the higher allocation in the budget for the infrastructure, and then the affordable housing segment. In addition to that, substantial demand from the e-commerce logistics area. Then the National Green Tribunal's order of banning all the diesel vehicles in the NCR region if it gets speculated to other areas, and also the Ministry of Transport has come out with, of course, currently it is voluntary, of replacing all 15-year vehicles with Basel IV, and some incentives also are being offered. So all these things, if you look at, point to a good amount of demand coming back. So therefore, I think the industry, I feel, CV's industry is expected to grow from now onwards.
What is your take on the way how the 10-year paper has started moving higher? Because if the bond yields are moving higher, your cost of borrowing from the market will also change. Up until now, NBFCs have benefited because if the cost of capital was coming down, banks were not lending. But the scenario will change now.
So cost of lending actually, it will not, cost of borrowing will not be the same for everybody. It depends on, it depends squarely on the balance sheet and how financially strong your balance sheet is. As you know, recently we got a rating upgrade from AA to AA+. So I think we will be able to maintain our cost of borrowing. Of course, over a period of time from 10%, it has come down to about less than 9%. Also, it depends on what kind of strategy, what kind of mix that you want to adopt for your sourcing your entire fund requirements. Therefore, I think, as long as your balance sheet is strong, there are a number of options by which you can raise your money.
Right. Do you think that this growth trend is sustainable in the LCV and CV segment? Is this the start of a multi-year revival in the cycle, so to speak?
So definitely, I think, because as I mentioned to you, one is the industry growth and then the growth for Cholamandalam. Industry growth, I just mentioned to you, what are all the demand triggers that could play in. As far as we are concerned, last 3 years, which have not been very good for the industry, we had maintained our growth in disbursement CAGR 20%, and also we had grown our loan book CAGR by 16%. Since this is because, we are present in a whole range of vehicles. We are present in used, we are present in new vehicles, we are present in HCVs, LCVs, SUVs, MUVs, cars, two-wheelers. Therefore, there is no particular segment actually, including tractors, there is no particular segment in which there is a concentration for us. So therefore, if you see every year, some segment is giving you some kind of growth potential. And also, we have expanded our reach. Last 3 years, from 520 branches, we have moved about now 720 branches. So therefore, we are in a position to cater to a larger segment. Therefore, I don't see any difficulty in maintaining the growth.
Right. Q2 actually, sir, did see a near 13% quarter-on-quarter pickup in disbursements and CV growth of 12.5% for you. However, we didn't see the home equity segment grow. In fact, there was, I think, a mild dip there. How do you see the growth in all these three segments going forward?
So home equity if you see, we had degrown in Q2. But, quarter on quarter for the last 3 quarters, we have increased our disbursement. But if you see the profit after tax in Q2 actually has grown by about 13% for home equity. The earlier the loan losses in this segment was higher for the previous 3 quarters, and that is actually coming to an end. But home equity right now, is under some kind of a pressure, margin pressure. This is a business which we have been doing for the last 10 years. We have been very conservative, and in this business we have not written off even 1 rupee as bad debt. There has been some provisions here and there, but every time provision is made at some point of time that is recovered. But what we are planning this year from now onwards to increase our presence. Out of the total 725 branches, home equity is offered only in about 130 branches. Probably to increase our reach, we will enhance our reach, and then to maybe about 250 to start with, and maybe a little more. Therefore, we will get more number of options. And this business, as I mentioned, we do it very conservatively in terms of LTV and in terms of margins. Unless we get our norms, proposal meets our norms, we don't actually proceed. Therefore, margins are right now under pressure. It is likely to be so, but likely to be so for some more time. But this business gives us roughly about 250 crores of profit every year. That, I think, around that level we will maintain. Once our expanded reach comes into play, we will be able to increase volumes.
So for FY 18 and 19, how much of your total contribution will come from the HFC and from the financing space, when I say the other NBFC activities?
So if you look at our portfolio, 70% of the portfolio is actually, in terms of assets, it's actually vehicle finance. 26% is right now on home equity, and then maybe out of the remaining 4%, a substantial part of it is coming from home loans. Home loans is actually a recent offering from us. Only we have started doing it last 3 years. Right now we have a portfolio of about 750 crores of home loans. The entire thing actually advanced to affordable housing segment. So the income component, likewise, roughly about 65 to 70% will come from vehicle finance. About 20% of the contribution will come from home equity, and then the rest is from treasury and other activities, including home loans. So this has been so for the last 2 years. It will also continue to be so, maybe in the year ahead as well.
Mr. Srinivasan, thanks very much for taking out the time to speak with us this morning. We really appreciate the insights you've offered in terms of how your business is shaping up in connection with what's happening with the broader CV market in the country. Wish you the very best for the future.
Thank you. Thank you.
Okay, to an exclusive story. Subrata Roy controls Sahara Group, its most prestigious asset.